Hey everybody, this is Ken Holman. Today we're going to talk about a really important real estate investing strategy, the 1031 Tax Deferred Exchange. This refers to Section 1031 of the Internal Revenue Code, which permits a taxpayer to defer the recognition of capital gains and related federal income tax liability on the exchange of certain types of property. It means you can exchange one property for another and defer the payment of any tax on the exchange. Before 2018, a wide array of property permitted the deferment of taxes. However, the Tax Cuts and Jobs Act of 2018 repealed Section 1031 for all types of properties except real property. What's real property? Real property refers to land and any property attached to it, such as buildings and other improvements. To qualify for Section 1031, the properties exchanged must be held for productive use in a trade or business or for investment. That means both the relinquished property and the replacement property must be held either for investment or for the productive use in a trade or business. The properties exchanged must be like kind, which means they must be of the same nature and character even if they differ in grade or quality. Real property must be exchanged for real property, although there's a broad definition of real estate that applies, which includes land, commercial property, and residential property. However, it does exclude the sale or purchase of your primary residence. So you can exchange an apartment building for an office building or land for a retail property, etc. But there are a couple of things you can't do. You can't exchange real estate for stocks or bonds. They're excluded from 1031 exchanges. Nor can you exchange real estate for an interest in an LLC, which is a limited liability company. There are some important rules you must also follow when doing a 1031 tax deferred exchange. First, the replacement property you select must be of equal or greater value than the one you're selling. Second, the proceeds from the sale must be held by a qualified intermediary. They're sometimes known as an accommodator. And third, you must identify the replacement property within 45 days of the settlement date of the property you just sold. And fourth, you must acquire the replacement property within 180 days of the settlement date. And the number of days, by the way, refers to calendar days, not business days. So weekends and holidays are included. So you might ask the question, what if I select a property that gets sold before I can buy it? Does this disqualify my 1031 tax deferred exchange? And the answer is yes. However, the government has given some leeway on the selection of property, and there are three rules that apply. The first is called the three property rule. You can select up to three properties regardless of their market values, but all identified properties are not required to be purchased to satisfy the exchange, only the number of properties needed to satisfy the value requirement. The second rule is called the 200% rule. Any number of properties may be specified as long as the aggregate fair market value of the replacement properties does not exceed 200% of the value of the relinquished properties or property. And third, that rule is called the 95% rule. And any number of replacement properties can be selected if the fair market value of the properties actually received by the end of the exchange period is at least 95% of the aggregate fair market value of all the potential replacement properties identified. In other words, 95% or all of the properties identified must be purchased or the entire exchange is invalidated. So these rules can be a bit confusing, but most people use the three property rule. They identify three replacement properties of equal or greater value than the property they are selling or relinquishing. And our company identifies these replacement properties for exchanges. If you have an exchange, give me a call. I can help you through the process, and my contact information is on the screen. So to summarize, 1031 tax deferred exchanges can be a great investing strategy if done properly. Remember, first, the exchange must be a like kind of exchange, meaning real estate for real estate held for investment or for a trade or business. The replacement property must be of equal or greater value than the relinquished property, and you must use a qualified intermediary to handle the exchange. You must identify the replacement property within 45 days of the settlement date using either the 3 property rule, the 200% rule, or the 95% rule. And the exchange must occur within 180 days of the settlement date of the property you sold. If you follow these rules, I can guarantee you're golden.